but have an understanding like this. Discuss the taxability or otherwise of the following in the hands of the recipient under section 56 subsection 2 clause 7, which we have already completed understanding of it. Akhil HUF received 75,000 in cash from a niece of Akhil, that is Akhil, that is a daughter of Akhil's sister. Akhil is a karta of the HUF. What I said, the amendment says if HUF receives any money from the its members, then it is not going to be taxed. But daughter of the Akhil's sister is not a relative. Daughter of Akhil's sister is not a relative from the HUF's point of view. HUF comprises of what? That is male and female, no problem. But married daughters and all are not the part of the HUF. Their daughters will they become? No. So in case if Akhil Bhai is receiving from his sister's daughter, that is a niece, then HUF of the HUF, that relationship will not get established. So since it is a cash gift in excess of 50,000, whole of it should become taxable. Then Nitisha, a member of her father's HUF. How come Nitisha became the member of her father's HUF friend? She is an unmarried daughter. Right. Nitisha, a member of her father's HUF, transferred a house property to the HUF without consideration. The stamp duty value of the house property is a 9 lakhs. What we say? Since Nitisha is a member of the HUF, so any gifts by the members of the HUF to the HUF is not taxable under the head income from other sources. Then friends, Akshat received 100 shares of A Limited from his friend as a gift on the occasion of 25th marriage anniversary. No chance, because on the occasion of the marriage, in case if he is receiving, it's okay. Not on the occasion of 25th marriage anniversary. The fair market value on the date is 100 per share. He also received jewelry worth of 45,000, fair market value from his nephew on the same day. So here the point of interest here is, put together what is it? This is 45,000 and 100 into 100. How much? 100 into 100 is how much? 10,000. Put together is what? 55,000. Since it is exceeding the 50,000 rupees, then automatically it gets a taxable is a point. Then Kishan HUF gifted a car to the son of Karta for achieving good marks in the 12th board examination. The fair market value of the car is 5,25,000. Car is a movable property, but it is not a movable property as defined in section 56 subsection 2 clause 7. So this is not taxable. Already I told, for movable properties they have given a list of items. Only when the gift falls in that particular list of items, then only the taxation comes into play. Car is although a movable property, for the income tax purpose it is not being covered by that particular list, so not taxable. Then Ms. Kartika purchased a land from PMC company, a partnership concern, for 7,15,000. The stamp duty value of the same was 12 lakhs. Land is an immobile property. As far as immobile properties are concerned, only when without consideration if it is received, then 56 comes into play. Other way around, stamp duty valuation provisions will have an application. So here, since it is an immobile property, it is not going to be taxed. This much of the clarity the institute is expecting from you when you go and write the exam, right? How this clarity comes, sir? One is listening, then is writing, then again relooking this before you enter into the examination hall. Refer before exam notes must always be there. Other way around, these many facts you can't remember. Write down good points. With respect to the HUF, only when it receives gifts from a relative, are not taxable. Its members, gifts from its members. That member become a relative as far as HUF is concerned. That's the amendment. Okay. Gifts from its relatives, not taxable. And member of the HUF is a relative of the HUF. Member of the HUF is a relative of the HUF. Then write down continuation. Gifts received from non-relatives. Gifts received from non-relatives if exceeds rupees 50,000, then the whole of the aggregate of it, becomes taxable. Then friends, in case, next point, in case aggregate fair market value of the property, value of the property, brackets, other than immobile property, exceeds, other than immobile property, received without consideration, exceeds rupees 50,000, then the whole of the aggregate value becomes taxable. Then friends, car is not included in the definition of property. Car is not included in the definition of movable property. Therefore, if the SSE receives the same, for inadequate consideration, without consideration, the same shall not be taxable. Lastly, most important point is Immovable property acquired for inadequate consideration. Immovable property acquired for inadequate consideration is not taxable under section 56 subsection 2. Is not taxable under section 56 subsection 2 clause 7. Now friends, one more illustration. Look at this. The following are the details of the shares issued by the Ray Private Limited, that means a closely held company. Discuss the applicability of provisions of section 56 subsection 2 clause 8b 7b. These are all definite questions, because today the questions are 2 marks, 3 marks. A small situation they create and give it, and more particularly if it is with respect to an amendment, if the student don't write, as a valuer we get irritated. I can expect you to do mistakes but not blunders. There are certain bailable crimes and non-bailable crimes. So if any question is set from amendments and if the student is not attempting it and writing properly, it is a non-bailable crime. So today or these 12 hours we are spending to see that we don't do the non-bailable crimes. Chalo, look at. See, face value is 100 rupees, fair market value is 120, issue price is 130. You are asked to discuss about the applicability of section 56 subsection 2 clause 7b. What we say, if shares are issued at a price more than the fair market value, then the difference between the issue price and the fair market value shall be treated as income from other sources. I already made you to write that. So the provisions of section 56 subsection 2 clause 7b are attracted in this case, since the shares are issued at a premium, issue price exceeds the fair market value. So the excess of the issue price over the issue price of the shares over the fair market value would be taxable under section 56 in the hands of the Ray. Then what is the face value? 100 rupees. What is the fair market value? 120. What is the issue price? Is 110. Issue price is less than the fair market value, so not a problem. No such sum is chargeable to tax. Whereas face value is 100 rupees, fair market value is 90 rupees and issue price is 98 rupees. What we say? Since shares are issued at a discount, here what is happening? Face value is 100, issue price is what? Issue price is 98. Once the shares are issued at a discount, even if the issue price is more than the fair market value, this provision will not get attracted. This is a new point. Write down the new point. Section 56 subsection 2 clause 7b, section 56 subsection 2 clause 7b is not attracted, since these shares are issued at a discount. Is not attracted, not since. If the shares are issued at a discount and issue price is more than the fair market value, and the issue price is more than the fair market value. What is the fourth situation, friends? 100 rupees is the face value, market value is 90 rupees and issue price is 110. Issue price is more than the face value and it is more than the fair market value. That difference of 20 rupees will be taxable as a income from other sources. So what type of question you can expect at the final level? You are well preparing and going to the exam with an understanding that a closely held company, if it issues the shares for a price more than the fair market value, the difference is to be taxed. Difference between the fair issue price and the fair market value is to be taxed under the head income from other sources. And you don't notice the fact that the fair market, that is your fair market value is less than the, what is it, your face value, and your issue price is less than the face value. Once issue price is less than the face value means what? It is being issued at a discount. That means these provisions are not applicable in case if the shares are issued at a discount. This provision is applicable only if shares are issued at a price more than the face value. So this provision is applicable only in case if the shares are issued at a premium, and moreover that premium what you are collecting, to the extent that premium is in excess of the market value, premium in which is the difference between the issue price and the fair market value, will be taxable under the head income from other sources. So that's how we have finished off with our income from other sources. After a small break for about 20 minutes, I'll come back to start with the topic of capital gains, where I have to run with 13 to 14 amendments. Please do stay with us. Thank you.